Welcome back in, everyone. I hope you're having a great day today. Today, I'm going to be going over my Mastercard thesis. The company's down 9% over the past year. The fundamentals are obviously still growing. This is a compounding machine, a true duopoly with Visa. It is very close to the perfect business in my eyes, and we're getting it at a price to free cash flow now of 27. With a PE of 32 as it grows intrinsically about 15 to 20% every single year for the past decade. I don't see this changing anytime soon. Just to start, let's go over some threats to the MasterCard business. First off, it lists fintech and digital wallets. Companies like Revolut, Block, Square, and digital wallet providers, Apple Pay, Google Pay, are integrating services like buy now, pay later, and peer-to-peer payments that can bypass traditional card rails. Just to be clear, MasterCard does have their own P2P payments through MasterCard Send and MasterCard Move. Also, to combat buy now, pay later services, since they aren't a bank, they don't issue debt, they have partnered up with all of their banks and other existing partners to offer installment-based payments, which is essentially the same thing as buy now, pay later. Next, it lists direct payment channels. Merchants are increasingly incentivized to use direct account-to-account channels to save on the 1 to 3% interchange fees typically charged by MasterCard and Visa. Recently, MasterCard has also faced this head-on as they now offer their own account-to-account service as well. Now, a real threat: real-time payments, RTP rails, government-backed systems like Pix in Brazil and UPI in India offer fast, low-cost alternatives that have already captured significant market share from established card networks. This is a threat as they're trying to avoid the fees, getting rid of the 1, 2, 3% fees that MasterCard, Visa, and other cards are putting on the consumer and merchants across their economies. However, there is a huge flaw in the system, that being cybersecurity, fraud detection, things like that. As you can see here, I just looked up Pix and UPI fraud rates 2025. It says in 2025, fraud rates for Pix, Brazil, and UPI India remained high, driven by rapid adoption and sophisticated social engineering, with Pix scams projected to reach 28 million cases and UPI fraud cases rising by 85% in full year 24. This is a little dated, but you still get the point. Nothing has changed in 2025. I believe they reported numbers in the middle of 2025 that showcased increased fraud in UPI. So in one situation, you have a lot higher fraud with Pix and UPI, as well as you're getting rid of the consumer-based credit card points. The cashback, 2% cashback here, 1% cashback on gas, 3% on groceries, whatever it is. Consumers love that, and they will continue to love that and be addicted to that going forward. The next threat listed is cryptocurrency and CBDCs. The rise of stablecoins and potential central bank digital currencies could eventually offer a parallel financial system that reduces reliance on legacy credit card infrastructure. This is another very small threat. I don't see stablecoins being a real threat, as it is an instant transaction. If anything were to go wrong, if the merchant wasn't to provide service or a product that's as described online, or if you change your mind, it's instant. It happens immediately with a Visa or MasterCard transaction. It has a processing fee. They are the ones responsible for making sure that a merchant holds up for the consumer and vice versa. It's reliable, it's trusted, it's safe, and it's very fast. It may not be immediate, but it's still very fast. It's like same day, the next day. It may not be within an instant, but it's still very, very fast, very reliable. It's the safest way to transfer money from merchant to consumer. With that being said, MasterCard has invested in their own stablecoin system. They offer stablecoin transactions already, and I'm sure if it becomes more popular, they will continue to invest further into that parallel. The next threat brought up, which I believe is a serious threat, is regulatory and legal threats. Mainly the biggest threat here I see is regulatory pressures on MasterCard and Visa from increasing transaction fees, which, if it wasn't for regulatory pressures, they could increase this drastically. Inflation's around 3%. I could see them increasing these close to 10% a year, maybe 5%, 4 or 5%. But realistically, Visa and MasterCard do have to be very careful here. But at the end of the day, if they were to push Visa or MasterCard away, this would drastically hurt the overall U.S. and world economy. We saw Trump recently talk about the 10% proposed credit card rates. This would take away credit access from millions of Americans, and I mean millions. Wells Fargo already came out and said this themselves. I just Googled what would happen to the economy if millions of Americans lost access to credit. It says, if millions of Americans lost access to credit, the U.S. economy would likely plunge into a severe recession. I don't see Trump or any government in the future putting their own economy or the world economy through massive recession just to combat very minimal processing fees. That is honestly worth paying for merchants and consumers, as it drives overall efficiency and activity within the marketplace. Last threat listed is operational and cyber threats. These are threats. They have been threats. MasterCard and Visa have been investing heavily into this space, and they often offer these services to other institutions and other products and services because they are so well equipped at combating cyber and operational threats, including fraud, skimming, card testing, other breaches. They're ahead of the game on that without a doubt. Now, most people understand Mastercard as a credit card issuer. That is far from what the business is, so I pulled up their 10K just to give a brief overview. Here's their business overview. It says Mastercard is a technology company in the global payments industry. We connect consumers, financial institutions, merchants, governments, digital partners, businesses, and other organizations worldwide by enabling electronic payments and making those payment transactions secure, simple, smart, and accessible. We make payments easier and more efficient by providing a wide range of payment solutions and services using our family of well-known and trusted brands, including our primary brand Mastercard, as well as Maestro and Cirrus brands. We operate a payments network that provides choice and flexibility for consumers, merchants, and our customers. Through our unique proprietary global payments network, we switch, authorize, clear, and settle payment transactions. We have additional payments capabilities that include automated clearing house ACH transactions, both batch and real-time account-based payments. Using these capabilities, we offer consumer and commercial payment products, capture new payment flows, and provide service and solutions. These services and solutions include, among others, security solutions, consumer acquisition and engagement services, business and market insights, digital and authentication, processing and gateway and other solutions, all of which draw on our principled and responsible use of secure data. Our capabilities strengthen, reinforce, and complement each other and are fundamentally independent. For our global payments network, our franchise model sets the standards and ground rules that balance value and risk across all stakeholders. We employ a multi-layered approach to help protect the global payments ecosystem in which we operate. Here's what they describe as their strategy. They state our strategy centers on growing our core, diversifying our customers and geographies, and building new areas for the future through a combination of organic and inorganic strategic initiatives. We are executing on this strategy through a focus on 3 priorities: consumer payments, commercial and new payment flows, and services and other solutions. Our priorities strengthen, complement, and reinforce each other and are fundamentally independent. Here's a little visual, shows our strategy: grow our core, diversify into new customers and geographies, build new areas of the future. Our strategic priorities: consumer payments, commercial and new payment flows, service and other solutions. This is all enabled by people, brand, data and AI, technology, franchise, and doing well by being good. Here's a little visual going over their business model, how it's basically a circular network and one thing positively affects the others. Payments volume goes to switching, switching goes to incremental data goes to data-driven services, data-driven services goes to differentiated offerings drive new and renewed customer deals, increases payment volumes. It's basically one big circle. As one thing succeeds, it moves on to the next thing. They say our payment network helps us scale our services and solutions, and those services and solutions help us differentiate our payment solutions. We grow in payments, which allows us to switch more transactions and bring more transaction data onto the network. We use that data to create insightful services and solutions that can, in turn, help us win new and renewed customer deals and drive greater payment volumes growth. Simply said, they're trying to drive more consumers to the Mastercard network. More swipes of the cards gives them more data, more proprietary data that no one else can have. They then take that data and repackage it to institutions, banks, governments that want to use that data. They then can offer differentiated offerings and special deals to consumers and merchants. This then provides them with increases in payment volume and overall cards. Another visual here goes over their payment network, as this is basically the foundation of their business, what it started off as. Mastercard takes care of the payment network. They take care of the switching, authorization, clearing, settlement, services and other solutions, and the payments ecosystem security. And it's a 5-sided network, so the more issuers, the more acquirers, the more merchants, and the more account holders that are on it. It provides more value to the 2 banks that acquire and the issuer, as well as it provides more value to the merchants and account holders or consumers within the network. In 2025 and years previous to that, they've been working on benefiting and innovating the payments ecosystem. Here they listed key 2025 developments. They stated, we launched Mastercard Agent Pay, a new framework designed to enable secure, scalable, and trusted payments in agentic commerce. The solution enables AI-assisted and fully automated agent-based payments across Mastercard's acceptance network. The solution builds upon our existing tokenization capabilities, including agentic tokens and dispute management capabilities. In 2025, we enabled all US-based Mastercard cardholders to participate in this program, with a global launch scheduled for early 2026. Merchants are currently able to participate without the need for significant development or integration. In 2025, we continued our efforts to support stablecoin across our network by enabling the spending of crypto and stablecoin assets across Mastercard's acceptance network through approximately 130 crypto co-brand card programs, embedding stablecoins into our Mastercard Move platform, which allows customers to send and receive stablecoin flows seamlessly. In 2025, approximately 40% of all Mastercard transactions are now tokenized. Here they're going over their services and other solutions, which is basically their value-added services, the fastest growing part of the business. It will soon be more than 50% of the revenues, probably within 2 to 3 years. They state that we offer an expansive and diversified portfolio of services and solutions built on unique and proprietary data sets and supported by global consulting and advisory expertise. These services and solutions help to differentiate our payment products and serve the needs of sizable addressable markets beyond payments. They offer security solutions such as prevention, identification, detection, remediation, and business continuity. Their 2025 key developments state in 2025, we launched Mastercard Threat Intelligence, which combines Mastercard's payment expertise and global network visibility with recorded futures leading cyber threat intelligence capabilities in order to prevent payment fraud by proactively detecting cyber attacks. This new service complements our existing cybersecurity intelligence, fraud scoring, and defense functionalities. In 2025, we launched Mastercard Commerce Media, a new digital media network aimed at making advertising more personalized, relevant, and effective. Mastercard Commerce Media helps advertisers provide tailored offers to the right consumer at the right time by using our proprietary spend insights as well as measuring the effectiveness of the advertisement. In 2025, we announced Mastercard's Account-to-Account Protect, a new solution designed to combine our fraud prevention technology with a new dispute resolution framework in order to safeguard consumers when making account-to-account payments. In 2025, we launched Merchant Cloud, a unified platform designed to offer a single point of entry to cutting-edge payments, including payment gateways, security solutions, and data, to simplify and support commerce growth in the global acceptance ecosystem and deliver exceptional experiences for end users. Basically, all 4 of these points are once again reassuring points, stating that they are fighting off the threats to the business, especially through cyber and security threats, as well as things like the account-to-account protect. They're also offering consumer acquisition and engagement services. This includes marketing services, personalization services, and issuer and merchant loyalty services. These are yet again like your specialized offers from different stores, banks, institutions for different cashback at different locations, things like that, things that keep consumers coming back to those stores or banks or institutions that then keep those banks, institutions, stores coming back to Mastercard. They also offer business and market insights. We offer solutions that provide data insights, analytics, and advisory services, all of which are designed to help our customers operate with agility, optimize performance and profitability, and innovate for future growth. Offerings within this area include business and operational intelligence, advanced analytics and AI, consulting and agentic solutions, as well as payments and portfolio optimization. This is once again another offering of their repackaged transaction data to provide more value to customers, providing more revenue growth over time. Here they once again restate all of their revenue sources, which is basically what we've already went over, but it says Mastercard is a payments network service provider that generates revenue from a wide range of payment solutions we provide to our customers. We classify our net revenues, which include the impact of rebates and incentives from contracts with customers, into 2 categories, 1 being payment network and 2 being value-added services and solutions. Within our payment network, revenue is primarily engaged from charging fees to our customers based on GDV, which includes both domestic and cross-border volume on the cards that carry our brands, and for providing switching and other network-related services. Within our value-added services and solutions, we generate revenue primarily related to the following: security solutions, consumer acquisition and engagement services, business and market insights, digital and authentic solutions, processing and gateway, and other solutions. Here they address their competition. They state that we face a number of competitors both within and outside of the global payments industry. We compete in all categories of payments, including paper-based payments and all forms of electronic payments, as well as in all categories in which we provide service and solutions. Listing off general purpose payment networks, this is things such as Visa, American Express. Then you have debit and local networks. This is once again like the India and Brazil payment rails, real-time account-based payment systems, digital wallets and other fintechs, digital public infrastructure and other government-backed solutions, once again, digital currencies, and services and solution providers. Here they state that we play a valuable role as a trusted intermediary in a complex system, creating value for individual stakeholders in the payments ecosystem overall. Our competitive advantages include our global network, highly adaptable and world-class global payments network that can reach a variety of parties to enable payments anywhere. franchise model, establishing rules, standards, and bearing of financial risk, including our settlement guarantee, backed by our strong credit standing. That allows for interoperability among all participants, multi-rail, multiple payments capabilities based on our innovation and technology that enable choice, brand, globally recognized and trusted brands, that's very important, data and AI, products and services utilizing our data and AI assets, technology platforms, and expertise that incorporate our data and tech responsibility principles and reflect our privacy by design, data by design, and AI governance process. Talent and culture, world-class talent and culture guided by the Mastercard way, with a focus on providing an environment where everyone has the opportunity to succeed. Technology, leading edge technology that advances the quality, speed, and diversity of our offerings and solutions. Local presence and government engagement, ability to serve a broad array of participants in global payments due to our expanded on-soil presence in individual markets and a heightened focus on working with governments. Collectively, the capabilities that we have created organically and those that we have obtained through acquisitions support and build upon each other to enhance the total proposition we offer our customers. They enable us to partner with many participants in the broader payments ecosystem and provide choice, security, and services to improve the value we provide to our customers. Here they list their risk factors. We've already gone over most of these: legal and regulatory, payments industry regulation, preferential and proactive government actions, privacy, data, AI, and information security, other regulation, litigation. They stated above in the 10K that they're working on all 5 of these actively and trying to keep regulation and legal scrutiny off of their backs, which they have done very well at historically, considering how dominant they are as a business. Then they say business and operations, competition and technology, brand reputational impact, and environmental, social, and governments, information security and operational resilience, talent and culture, stakeholder relationships, acquisitions and strategic investments, global economic and political environment, settlement and third-party obligations. These are all very obvious risks to MasterCard. A lot of these are risks to every business in the world. I'm not going to go through their whole staff, but I will highlight the CEO, Michael Maybach, President and Chief Executive Officer since January 21. He was the president starting in 2020. Chief Product Officer from 2016 to 2020. President of their Middle East and Africa operations from 2010 to 2015. Beforehand, I believe he worked at Citigroup. Yes, it says it over here. Positions at Citigroup. And I believe another big institution. Yeah, Barclays as well. So very established CEO. He's done a great job since 2021, including a big acquisition. So I truly believe in Michael. Now that we have a brief overview through the 10K over the business overall, I just want to state my case for MasterCard. I believe that they are vital to the world economy as well as the U.S. economy. Without their safe payment rails, them and Visa, they could do it with one of them, although it would be a monopoly. So I think they'll both coexist for a very long time. They basically are sitting on the bridge between merchants and consumers worldwide. Without MasterCard or Visa, transactions volume would be very slow. We'd have a lot more fraud. We'd have a lot more risk. We'd have slowed transaction growth due to the fraud and due to the risk, due to slowed down transactions. I believe that they will continue to enhance their offerings through payment processing. They will continue to add more cards. They're above 3.5 billion active cards today. And with all of the data that they get through all of their transactions worldwide, from merchants to consumers, they will continue to repackage that information using AI to leverage that data and repackage it to banks, institutions, stores, governments to offer more value to those institutions at really high margins, as it's already data that they are already handling. They already have to store that data. So it's just really a cherry on top, and it has accelerated the growth of this company. I wanted to hop over to Qualtrim just to show you guys a little bit of how the value-added services are growing. As you can see here, they've been tracking it since Q4 23. So as you can see, overall revenue over the past 2 years is up about 14.5%. Over the past 1 year, 16.5%. But if we look at payment networks, it's a little slower. It's still really good growth, 10% revenue growth. This is great. But if you look at value-added services, it's 20% growth. Over the past 1 year, it's 23% growth. This is explosive. This is, we're going from Q4 2023, 9.3 billion to now Q4 2025, 13.3 billion. And this number is going to continue to grow. As you can see, it's accelerating, and they're guiding for acceleration. Total MasterCards, as you can see, 2012, we had 1 billion. Now we have 3.4 billion MasterCards active in the world. Q4 2025, 13 years, it has over tripled. Revenue overall over the past 10 years, we're growing at 13% annually. And as you can see, we're accelerating. 1 year, 16%. And this is one of the most impressive charts in the whole company. over the whole time. I mean, it's growing every year, year after year, almost quarter after quarter, even. You might see some slight dips. The whole world economy shut down, and their big dip was from 17 billion at their peak down to 15.3 billion. They lost what? What is that? Exactly 10% of their revenues after the whole global economy shut down. They only lost 10% of revenue over that time. And then right afterwards, business as usual, straight back and up to the right. I expect the same thing to happen. We're going to look at this chart 5 years from now, and it's just going to be way up here where it says S&P 500. That's where the revenue is going to be. So, I mean, phenomenal company. They're headed in the right direction. Let's go ahead and look at the EBITDA. Same thing. Looks basically the same as the revenue dip in 2020. This is rough. Long time ago, the business has come a long way from now. Net income, pretty much the same thing. You have some dips. You'll have a lot of like tax breaks. You'll see big spikes due to taxes or big dips due to taxes, but overall still up and to the right. Past 10 years, 15% growth almost. Past 1 year, 16%. I expect that same trajectory. And free cash flow per share, which is what's most, free cash flow is important, but free cash flow per share is what really matters. We're looking at 19.2% growth over the past 10 years. Past 5 years, close to 24%. Same as 2 years. Past 1 year, we're looking at 27% growth. Same as EPS, I believe. Yeah, not as much, but the earnings per share is still growing rapidly. 17%, 21% past 5 years, 18 and 19% over the past 2 and 1 years. So once again, it is accelerating. 18% 2 years ago, almost 19% this year. And the per share basis, or the per share metrics from free cash flow and EPS, that's all fueled by the share purchases or the share buybacks, which negatively affects the shares outstanding, which is great, which is what you want to see. They're actively buying back your partners. People are selling their shares to the company. So over the past 10 years, they've bought a little more than 2% of the shares outstanding back per year, and it's been relatively consistent. 2% per year, a little more than 2% per year is what to expect, as well as the dividends. You get returns from dividends. As you can see, one of the best dividend growing stocks in the world. Them and Mastercard are both about the same with this. Past 10 years, you're looking at 16.6% growth every single year. Past 1 year, it's about 15%, so still right on track. But even look, where's 2020? 2020, they lost revenues, but they still continue to grow the dividend. And that's going to happen unless something really, really bad happens, all because of the payout ratio. Only 18% of their free cash flow goes to dividends. So they could realistically pay 100% of it back, which would pay 5x the dividend, but they're not going to do that. They're obviously reinvesting into growth in the company as well as repurchasing shares. As you can see, they've been historically buying more shares back than paying dividends in terms of capital allocation. Annually, you can see return on capital employed. This is one of everyone's favorite metrics to look at for high quality businesses. This is unreal. 60% is unheard of. On their bad year, the whole world economy shut down. They had a sad 37.5 return on capital employed. That would still be one of the best businesses in the world if they were at 37%. This company is phenomenal. Profit margins in the mid 40s, operating margins in the mid 50s, gross margins in the mid 70s. So it's very high margin. It's very low reinvestment needs. As you can see, big spike here. That's general administrative. That's fine. No big deal. That's honestly the biggest part of their expenses overall. But as you can see, it's growing a lot less than their revenues, free cash flows, and earnings per share over time, especially if you look 1%, 3%. So they're headed in the right direction. The balance sheet's fine. They're almost the same amount of cash as debt. So they're net, what is that, minus $7 billion. That honestly doesn't do anything when you bring in $17 billion in 2025 in free cash flow alone. So they could pay off their whole debt in 2026's cash flows and then still remain their $11 billion cash. I wanted to hop over to my X page. I kind of gave a brief overview of how I invest into companies. I just kind of wanted to explain how I went through this process with Mastercard. I'm continually doing it with this company as well as the other ones I hold and the ones on my watch list. So I start off step 1, my basic understandings. In order for me to begin thinking about where the business will be in the future, I have to understand the entirety of the company, what I'm looking for, business model, the blueprint on how they create value for customers to generate profits in their return. We already went through that with the 10K. They lay that out great for us. They provide transaction rails, trust, quickness, and transactions across borders worldwide all the time. They then repackage the data that they have to keep from transactions, and they pour that back into other offered services to institutions, banks, stores, and other entities. Revenue streams, every avenue that the business brings in or has potential to bring in revenue in the future. We already went over that through transaction fees as well as their value-added services. Is it understandable? I look for companies that are easy to understand, not companies that require a degree in a specific field in order to understand their products or services. I believe Mastercard is very easy to understand for you, me, and anyone else. Basically, they take your money, they give it to the merchant, or give it to them, take it from a merchant, give it to the merchant, and vice versa. They handle it from bank to bank, merchant to consumer, as well as the value-added services. They take the information that they get from all these transactions and they repackage it, as well as other services like cybersecurity, which is all repackaged from their already existing operations, and they're doing it for additional customers. Industry stability. I want to make sure the sector that the business is operating in will be around and preferably growing for the foreseeable future. I believe that people will be transacting for as long as the world exists for the most part. Maybe after a nuclear war or something, I won't be worried too much about my portfolio at that point. And here I said, if I fail to understand all four of these topics of the business, if I fail to understand all four of these topics, or if the business already has a red flag, I stop here and I put this company back on the shelf. If I fully understand all four topics on the business and everything looks great so far, I move on to step 2 of my process. Step 2 being the going over the business quality. The most important step, I would say. Step 1's important, you got to start there. But here I'm looking for the best companies in the entire world with a great moat around the business and ample ability to produce future profits. What I'm looking for is competitive advantages. Arguably the most important aspect of any business you plan on investing in. What protects the company from competitive forces? This can be network effects, switching costs, natural monopolies or oligopolies, strong brand power, and effective scale. The more the merrier. And I believe that Mastercard basically benefits from all of these. They have an insane 5-sided network effect. The more people on the network, this benefits the merchant, the consumer, the bank of the merchant, the bank of the consumer, and Mastercard. Switching costs, it's very hard for them to swap from Mastercard to a Visa or a Discover or another competitor, as it would take weeks and weeks, probably often months of switching everyone's card over to the different network. Natural monopolies or oligopolies. This is a natural duopoly, which fits in. With Visa, there are players, American Express, Discover, but the two giant players in the space is Visa and Mastercard. As you can see, nearly 3.5 billion cards. Strong brand power. They have a very strong brand. People have been trusting and using Mastercard for my entire life and before that. And effective scale, yet again, 3.5 billion cards. They are all over the world. So everything checks off for the competitive advantages. Very strong company. They're fighting off competition. They do face it, but it's basically a shared space between Visa and Mastercard. Next up, pricing power. I want my business to have the ability to raise their prices above the rate of inflation over long periods of time, allowing them to improve profitability. This is often a byproduct of a business with great competitive advantages. This again, they have incredible pricing power. It's so incredible that worldwide governments, US, EU, they're constantly pressuring Visa and MasterCard. At the same time, they cannot get rid of them. So if they were to choke out Visa and MasterCard due to regulations, they would crash their own economy. They will continue to price above inflation, especially in value-added services, as they don't face nearly the amount of regulatory pressures in that revenue segment. Next up, organic growth. Businesses that have the ability to grow revenues, market share, and customer base by staying inside of their business segment that they're already in. Companies that have to rely on growth through acquisitions or entering different untested markets are a lot riskier bets. With that being said, as you can see, let me pull this up. As you can see, I looked at what percentage transaction volume worldwide is done in cash. Cash accounts for approximately 46% of worldwide payments by transaction volume as of 2025, continuing a steady decline from 50% in 2023. I believe there will be a world in the future that maybe 80, 90, 95% of all transactions worldwide will be done digitally, which significantly helps Mastercard's organic growth pathway, as well as with that additional information from the payment processing that will continue to add value to the value-added services part of the business. So I see great opportunities for organic growth. And high returns on capital, we looked at that. It's like 60% on capital employed. It's unreal. I want my company to have the capability of reliably getting higher returns on capital than the cost of capital. If capital costs 5%, I want to see returns at the very minimum of 10% on capital deployed going forward. So even if the cost of capital went up to 10%, if they're getting 60% on their capital employed, they're making 50% net, which is really impressive. So, and I don't know if they'll continue at 60%, but I do believe that they will get great returns on their future investments. If the business does not have all of the above, we once again place it back on the shelf. If it comes close to perfect, I will place it on a watch list and look for future developments that could possibly strengthen the company. I believe Mastercard does check off all the boxes here with flying colors, honestly. If the business has passed every test at this point, I move on to step 3 of my process. Step 3, I'm looking for a strong management team. I look for management teams that I believe are heading in the right direction with the business overall. What I'm looking for, direction of the business. If I made it this far in my research, I know that they have a very strong core business model. That being said, I don't want management straying off course, especially if there's uncertainty whether or not the new endeavors will pay off in the long run or not. I prefer them to stay the course and find ways to make improvements or value additive additions to their already existing successful business. This is exactly what Mastercard did. They stayed in their lane. They kept improving their core business model through processing payments. They then took the information that they already had through that business. They repackaged it. They didn't go out and acquire a new player or enter a new business. They could have started any other business model. Instead, they decided to repackage what they already had and offered it as an additional service with very minimal additional cost, as well as acquisitions. They've only done some small tuck-in acquisitions. We'll go over that next. Smart capital allocation. I want the management team to be smart with the balance sheet in general, avoiding unnecessary acquisitions, debt loads, and dilution of shares outstanding. I would much prefer them to keep the business running smooth, performing tuck-in acquisitions when appropriate, and returning the rest of leftover free cash flow to either pay off outstanding debts or paying out dividends / buying back shares. With that being said, they have done some small acquisitions. None of them have moved the needle in terms of the balance sheet or anything, and they have improved the overall value that they're adding to consumers, merchants, and institutions that they deal with, as well as buybacks. They're constantly doing buybacks. They're constantly paying off dividends, and they have a very nice balance sheet. As we saw earlier, they barely have more debt than cash, so they're sitting pretty on the balance sheet. If management team is reckless or heading in a direction I don't like, I will keep an eye on developments going forward, but keep it on the watch list rather than making it into my portfolio just yet. If I am aligned with management and it seems like they're operating smoothly, I will continue to my last step in my process. The fourth step, step 4, valuation. This is the very last step of my process, as I want to avoid looking at a cheap company or companies because they are often not as durable and typically don't give great returns to shareholders over the long term. An investment should be valued as the current price of future free cash flows of the business. What I'm looking for, reasonable prices relative to the long-term growth expectations. At this point in my research, I have a good idea of how I view the forward-looking growth of the company to look like long-term. If I believe the company has the full ability to compound its free cash flow per share around 10% annually over the long term, I'm more than happy to buy shares around a 5% free cash flow yield or higher. The higher the growth expectations I have, the lower the yield I'm willing to pay is. If the valuation is severely overvalued, I will simply put it on a watch list and look for an entry in the future. I did this with Mastercard. I wanted to enter the company for a long time. The stock has been flat to down over the past year, and the fundamentals have continued to grow around 16% over the past year. So it's significantly cheaper than it was 1 year ago. If the valuation is at a fair price or even better, undervalued, I will allocate a hefty amount of capital into a position and follow the developments of the company over time with the intention of allowing the company to compound wealth for me while I sit back and monitor the situation from time to time. All right, so with that being said, let's look at the valuation of the company, Mastercard. I think I've laid out my case. I believe this is a very strong company. It's going to continue to grow. Let's see what we're looking at. Revenue growth. Revenue growth past 10 years, 12% or 13% actually. Past 1 year, 16%. I think a very realistic case we could look at here is we see revenue grow continually. Let's do 12%. It's lower than every number here. So 12%, very, very reasonable. We're getting a 3.7 yield. After dilution, we're getting a 3.6. So we're actually getting a 3.6 yield. Free cash flow per share. Once again, they're buying back shares. So this is going to go up a lot more. Margins do have more room to expand, although I don't see that happening too much. Maybe slightly, especially with the growth of value-added services. But over the past 10 years, we're looking at 20%, and that's the lowest number here. I think 20% is a little high, but it's very doable for this company. But let's just say, let's go over to a DCF. Let's pull up Mastercard free cash flow. Let's say it's down to 18%. Oh, 18%. We're currently at a free cash flow yield of 3.7. After stock-based comp, it's about 3.6. For a company growing around 18% per year, it should be, especially with how wide of a moat Mastercard is and how important it is to the global economy, it should realistically trade around a 2.5. Oh, 2.5. I think this is a little steep. They do go through a lot of regulatory pressure. People frown upon the company a lot. So maybe we trade at a 3. Or if we just keep the same valuation as today, 3.6, we still get our 18% return, which is phenomenal. Q1 2031, we're looking at 1.2 thousand per share, doubling up every 5 years. I'm more than happy with that. I do believe the company deserves a rating of about a 3. I would personally pay a 3 for the quality of this company, but like I said, I'm always looking for a great entry point. So I started buying around a 3.5 free cash flow yield. Now it's around a 3.7, 3.6 after dilution. So let's just say 3.25, 18% growth. I believe the company has a chance to, outperform expectations. Maybe not 24. Let's say 20% free cash flow per share growth. If they do trade down at that 3 free cash flow yield, you're looking at 25% growth per year. With that being said, let's pull up a calculator actually. So just off the free cash flow alone, if we're getting a 3.6 yield after dilution, if we grow this thing, let's say I hold the company for 10 years and they grow free cash flow per share at just 15% per year for 10 years, our free cash flow yield on cost at that point would be 14.5%. If we did this for another 10 years, let's say I held it for 20 years total, we would be looking at a 59% free cash flow yield on cost. So if the company is paying me out 59% of my original investment in free cash flow alone per year, 20 years from now, I will be a very rich man from this investment, as I have thousands of dollars in the company at this time. So that's all I have to lay out for Mastercard today. Make sure to go over to X, follow me on there. I'm always posting on there, posting different charts, different things that I find. As you can see, I was looking at the 10K for Mastercard last night. It's kind of what inspired me to do this video. I was going through Mastercard again. I'll always post polls, and I'm always doing little deep dives on different companies. As you can see, I did one on Mastercard, was my most recent one. I did one on Intuit. I did one on Meta. I wrote an article on how I plan on beating the S&P 500. A lot of good content over there. You can always reach out to me. You can DM me as well on here. But yeah, that's it for today. I hope you guys got some value out of this. Let me know if you're invested in Mastercard yourself. And if you have any questions about Mastercard or my investment thesis about it, if you have any counterpoints, I would love to hear them down in the comments. And don't forget to subscribe on your way out today. Thanks so much for watching. Have a good one.